again its return beyond the market benchmark level to understand the dynamics of the market and accordingly have an exit strategy in place. Uh, and it's not today; it has been for since the days we speak about mythology, and if we consider Mahabharata as the biggest theme, then obviously in Mahabharata it was being mentioned that Arjun knew the art of entry and exit from the Chakravyuh, but his son, who understood how to enter a Chakravyuh, he because he learned it when he was a kid, but when he entered the Chakravyuh, the biggest challenge he faced was how to come out of that Chakravyuh. And when we speak about market, there are many aspects of the market. So obviously, in the quality names, in the blue chip names, at least that challenge is not there. Maybe it might create an issue of underperformance for a few years, but eventually the sector will see a reversal. But that also will create a lot of underperformance. Just to give you a data point, auto as a basket didn't do anything from 2016 to almost 2022. So this was almost 6 years of consolidation or profit booking which happened in the auto space. Same is the case with pharma as a theme. So pharma peaked out somewhere in 2015, and it took almost 7-8 years for pharma to reach to the same level we saw in 2015. So generally, as an investor, it will create a lot of nervousness, because when you will see the index moving, let's say from 8,000 to almost 22,000, 20,000 kind of trajectory, and in that phase, if your sectors or companies which you are holding, if they don't do anything or if they correct 30-40%, it might create a lot of nervousness. So maybe these companies could be quality names from a good sector, but even though it will create a lot of underperformance, but at least it will see some recovery after 3 year, 4 year, or 5 year of underperformance. But the second aspect of market is where we are talking about the thematic ideas, fancy names, small cap names, or something which is the current very hot theme. In these kind of themes, if you in or stocks, if you go wrong and if you don't have an exit plan, then the challenge is these stocks can see correction which can extend to not restrict to 30-40%, but they might go towards 80-90% kind of correction. And even if the recovery happens, the recovery is going to be very, very limited. So in his book, the book called as by the father of investing, the intelligent investor, where he mentioned that if a stock corrects from 500 rupee to 50 rupee, this is a 90% correction. But for the same stock to see a recovery from 50 to 5,000, it will require at least 5,000 percentage high. And that's where the challenge is. In a stock which has corrected 70, 80, 90%, it's really very, very difficult for the stock to see a recovery. There could be one or two exceptions, but in 80 to 90% of the cases, what we have observed in the last cycles of 2004, 2008, 2012, 2018 correction, we have seen that many of these stocks which have seen sharper correction because they were thematic fancy names at those point of time, but they have hardly seen any recovery in the next bull market. So this kind of challenges investors face day to day, and that's where the art of exit or selling a stock becomes a very, very crucial important thing. So now we'll go with the presentation and we'll go by topic. What we do, we combine fundamentals along with technicals to identify what is the right time to take an exit. So maybe in many cases after our exit also the stock can see a recovery, but at least because we have an important tool named as we call it as a Brahmastra, which is nothing but technical analysis. It helps us in understanding that we have gone wrong and we can always take a re-entry. But in 80% of the cases, if the stock doesn't see a recovery, then the correction from those levels, we have seen a very sharper downside. And that's why, it's very important to follow up a process of following a rule where we know that if there's some serious breach of technical confirmation along with deterioration in quality of earnings or change in the valuation metrics which the market is anticipating, then we have seen very sharper correction coming into stocks. So now we go into a life cycle of a business where typically in the introduction stage, when a company is in an early stage, generally the sales is low. The sales are generally low because company is incurring a lot of cost, maybe branding or marketing, advertisement, fixed costs. So a lot of high cost is there, and obviously the sales is in a smaller number. So this will create either no profit or there will be a significant loss. So generally this we are observing in new age companies like Zomato and all, where the costs are high. Obviously profits are low or just EBITDA it has turned positive, but still it has not entered into a phase of very high profit growth. So this is the introduction stage. Then comes a stage where now the fixed cost is getting absorbed. Market is realizing the potential of a product, and that's how the sales have started moving up. So in this situation, the sales is increasing, cost gets absorbed because the fixed cost doesn't increase with incremental top line growth or sales growth, and that's why the cost gets reduced and the company starts making some profits. And once the market realizes that the product is really nice and there is a distribution reach the company has created, then automatically the top line starts growing very well, which creates a very consistent top line growth. Obviously now the fixed cost is more or less the same, and with rising awareness about the product, obviously the sales and marketing expenses also comes down, which ultimately results in increasing profits. So this is what we call as a maturity stage. The fourth stage is basically where the market size is not growing and the sales starts to remain plateau, and the company is not able to identify a new product, new geographical reach, or the new usage of the product, which ultimately results in reducing sales. But obviously your fixed costs are the same, so it will result in reducing profitability. And that's where one very important thing happens is obviously the EPS growth will slow down, and once the EPS growth slows down, the PE multiple starts to derate. So I'll give you an example. Specialty chemical companies, there's an example of a company called Deepak Nitrite. So Deepak Nitrite was available at 320 rupee and the stock was trading at a 10 PE multiple, and suddenly company started a new product. This new product got a very good market, and suddenly 80-85% of the capacity utilization happened within 9 months of the capex, which resulted in a very significant rise in the top line. So the top line increased, obviously the profitability increased faster because the fixed cost was same. So the profit increased and market started giving a very high PE multiple. So suddenly from the 10 PE multiple, the stock became a 15 PE multiple. Again, in the next quarter, when the numbers came very good. So market said that why should we give a 15 PE multiple for a company which is growing at, let's say, 25-30% kind of growth. So market again increased the PE multiple and the PE multiple went to 20. That's how this journey started from 2017 till 2020-21. There was a continuous upgrade in the PE re-rating because the profits were growing very fast. And there was a time when the stock reached a PE multiple of almost 40 to 50 PE multiple on a trailing basis because the earning growth was very, very high. But when in 2021-22, when interest rates started moving up globally, suddenly there was a pressure globally that because of rising interest rate, ultimately there was a slowdown, and this slowdown actually impacted entire specialty chemical companies from two perspectives. One, the top line growth started coming down because the demand started tapering, and because there was a supply chain issue which started happening due to Russia-Ukraine war, it also resulted in the raw material volatility. So most of the specialty chemical companies got hurt due to raw material prices going up significantly, and because the sales started coming down because there was a global slowdown. So the EBITDA margins collapsed significantly. And suddenly market realized that a company which was growing so fast, there was a significant EPS growth, is now seeing a slowdown in the EPS growth, or actually profits have started coming down. When the profit starts to come down, it is not just just because of the EPS which you derate the stock. The PE multiple starts also coming down. So just to give you an example, let's say a 100 rupee EPS at a 40 PE multiple, the stock price ideally should be 4,000 rupee. But when the EPS comes down from 100 to 70, generally in this situation, market will say that why should we give a high PE multiple to a company which is seeing a degrowth in the earnings. And that is how the 100 rupee EPS, which starts to come down to 70, market says that we are not going to give a 40 PE multiple to this company. Now the PE multiple ideally in this situation should be 30. So now the 30 PE multiple with a 80 rupee EPS is the target or the price comes around 2,400. Now imagine, earlier you were giving 100 EPS for a 40 PE multiple, so 4,000 rupee stock. Now that same stock is, we are looking from a target perspective of 2,400 rupee, which means there is going to be there should be a significant 1,600 rupee drop in the stock price, not just because of EPS coming down, but also because the PE multiple got derated, and that is what happens in the decline stage. So this is what we have tried to explain on the right side of the chart, where in a high growth situation, market starts to give high PE multiple, and once the EPS starts to come down, then automatically the downward revision starts to happen, both from the EPS perspective as well as from the PE perspective. There is a concept called as contrarian investing. So generally, when we see that after a certain stage, if the stock starts to continuously correct for 3 months, 6 months, and let's say in this case a 40 PE multiple comes to 25 PE multiple, then at some point of time market will say that okay, this stock earlier we used to give a PE multiple of 40, it has corrected to a 25 PE multiple, earnings have come down significantly, but there are now green shoots. Now there is a possibility that because now interest rates have started coming down, there is a possibility the demand will come back. And if the demand starts to come back, then at least you will see the top line starts growing very well. As far as raw material volatility is concerned, due to now we are aware that obviously crude has also seen a sharper correction from 92 to almost 76 odd dollars. So in this kind of situation, you will see a lot of volatility in the raw material coming down, which will result in raw material prices coming down and ultimately resulting in the margin expansion. So at this point of time, the contrarians will come into play and say that now, because the EPS is expected to grow further, why should we give a PE multiple of 25 to a stock which is going to grow well? This is a time we have to take a contra bet, because in next 3 to 4 quarters, earnings are expected to grow, and that is a time when a lot of contrarians will start giving up, will thought of buying the stock, assuming that market will again start giving 35-40 PE multiple to this business, and that's how again the re-rating happens. And that's what we say from a contrarian. Again, the positive surprise come. One positive surprise will give a lot of confirmation to the analyst community, and they will again say upgrade their numbers, EPS, and that's how a fresh EPS growth. Then again the PE will get re-rated, and that's how the positive surprise models will come. Estimate will get revision, EPS momentum will start coming, and again the stock will enter into the same life cycle of growth, and from growth it will again go to a contrarian. So these are some thoughts which most of the fundamental models try to understand from an earnings perspective. Now, before coming to what to sell, first we need to understand what leads to growth in earnings. So let's say if there is a new product innovation, then the market will say that okay, we were giving a very high PE multiple to a company. Let's say Astral is an example, which we have seen in the last 5-6 years has consistently been trading at a very high PE multiple. Now, what's the rationale? Because market believe that this company has got a capability for a lot of product innovation. So from pipes, this company is now becoming to a complete home building solutions, and that's where market has started believing that okay, when Asian Paints can trade at a 50 PE multiple, or a company like a lot of other companies in the home building solutions, they trade in a 40 to 50 PE multiple. Now Astral, which is entering into from pipes to a home building solution, should typically get a high PE multiple because of this new product innovation. Suddenly a pipe company which market used to consider at one point of time as a commodity company, now is considered as a consumer facing company, and that's why high PE multiple starts giving to companies like Astral, or maybe companies like Polycab, which has also started a business of FMEG. So suddenly when it got its IPO in the market, that time the stock was available at 620 rupee. The PE multiple of the stock was 10. And now, because in the wires and cable segment, obviously Polycab has gained a lot of market share. But apart from that, the FMEG business started contributing, and that's why market said that why should we give a 10 PE multiple to Polycab, since it is entering into FMEG business, and slowly it will gain a lot of market share. And that's the reason market will start giving a PE multiple of a consumer durable company to companies like Polycab. Geographical expansion is also one such thing. So Varun Beverages started expanding into African continent, and that's why market opportunity size started becoming bigger for a company like Varun Beverages. So market continued to give high PE multiple to companies which enters into new geographies. Growth in end user industry, we spoke about wire and cable industry. So ultimately, wires and cables are used in real estate, in the capex manufacturing theme, and we all know that we are seeing a significant amount of growth in the real estate registrations. The inventory level in real estate sector has come to 12 months, which at one point of time used to be 48 months. So there is a significant reduction in the I would say the inventory level, and which will result into the pricing power to the organized players. And that's what we are seeing in the Bombay market, in Delhi market, in Bangalore, where prices are going up. And because this real estate market is growing so well, because government is putting so much capex, so in this budget government announced a capex of almost 10 lakh crore, and this is a very, very significant number. We are seeing capex not only in the capex side, but also in the railways, defense, everywhere. And this will ultimately result in manufacturing and capex cycle to do well. All this will lead to a significant usage of wires and cables. So suddenly, because the end user industry is growing well, it will eventually benefit an ancillary company like wires and cables. And that's the reason, despite these stocks trading at a 40-45 PE multiple, most of these stocks in the sector, whether it's Apar, KEI, Polycab, Havels, most of these companies are trading at a significant high level, despite having a high PE multiple, just because the end user industry has grown up. Then there's a very important, interesting case. When a company starts taking market share from other companies, that also leads to a significant re-rating in the PE multiple. Before Sting, this was Red Bull was considered as the best energy drink. But suddenly, Varun Beverages launched a product called Sting Energy, and it gained a lot of market share from Red Bull. And that's how, despite being trading at a high PE multiple, we are seeing a sustained rise in the prices of Varun Beverages, because market believes the earning growth momentum is going to be good, because it has introduced a new product called as Sting Energy and gaining a lot of market share from Red Bull. Industry growth. So, I remember the case where in 2015-16, when most of the money managers, when they used to interact with clients, there was a one clear line which they used to say: we don't enter into PSU companies, we don't buy defense, we don't buy railways, because that was considered as something which is which a lot of people believe that maybe because of government involvement, or maybe the pricing power is not there, these companies will not be able to deliver very significant returns. But suddenly, when there is a significant industry growth, then a lot of these thought processes changes. Suddenly in 2016-17, when government continuously started mentioning that we are going to put a lot of capex in defense, and we are going to do a lot of indigenization. So ultimately, at one point of time, we used to import almost 65 to 70% of our requirement in defense, and that number has come down to 30-35%, which means the domestic companies, our own defense companies, they started doing a lot of indigenization work, and that's the reason our import dependency started coming down, which resulted into a significant growth for these defense companies. And that's how a company like Bharat Electronics, which at one point of time used to trade at 8 or 9 PE multiple, now is getting a significantly higher PE multiple. Same is the case with a company like Hindustan Aeronautics or Bharat Dynamics Limited, because at this point of time, I'll give you an example. The top line of Bharat Dynamics Limited is around 2,800 crore. But if you look at the order book, it is close to 20 to 23,000 crore, which means almost 9 times revenue visibility is there, which clearly indicates that company has a potential to grow at 18 to 20% year on year for next 4 to 5 years. And if this is the possibility, then market will start giving high PE multiple. And that's the reason at one point of time, these companies used to get a PE multiple of 8, 9, 10 times. Now, these companies are getting multiples beyond 25 to 30 because of the significant industry growth we are witnessing in the defense segment. So these are some of the examples which we have tried to understand that which leads, what are the factors which leads to significant growth. So we firmly believe in the style of Peter Lynch, who is considered as one of the best money manager in the history. So there's a quote which says that if you can follow only one bit of data, follow the earnings, assuming the company in question has earnings. I subscribe to the crusty notion that sooner or later, earnings make or break an investment in equities. What the stock price does today, tomorrow, or next week is only a distraction, which means whether we are talking about growth or value or all these things, but ultimately for a sustainable rise in the price of the stock, what is the most important aspect is the growth in the earning. That's why you'll observe that a lot of companies which are trading at 30, 40, 50 PE multiple, they continue to remain at an elevated PE multiple. The reason being the earning growth momentum is very strong in these companies. Market firmly believe that one who has proven in terms of earning growth, they will continue to surprise the market on the positive side. And that's the reason always high PE multiples are given to these companies. A lot of people ignore these companies because they believe that, okay, the stocks are trading at 30, 40 PE multiples. So now we will not see, significant upside coming from the stock. But market has proven it time and again. Let's take an example of a company like Varun Beverages. At one point of time, when I used to interact with a lot of analysts, they were of the firm belief that there is now very limited upside in the stock because it is trading at a very high PE multiple. But one fine day, Varun Beverages surprised with its listing ring. Varun Beverages surprised with entering into an African continent. Varun Beverages surprised with saying that we are going to now produce the chips, and that's where from drinks to they are entering into the chips market, which is also a very, very big market. And that's where market believe that the earning growth is going to be very positive, and that's the reason high PE multiple should be given to these names. So the most important aspect is earning growth. And when the earning growth starts to taper down, or let's say even if there is no downtick in the earning, but there is no significant growth or EPS growth which comes, then the stock enters into a significant period of consolidation. So obviously, if these companies are quality names, what will best happen is they will not see significant correction, but they will enter into a serious time correction. And what do we mean by time correction? Let's take an example of a company called Microsoft. From 2002 to 2000, I would say 18, almost 16 years, the stock consolidated at around same levels, which means it didn't deliver any return. So obviously it was a quality company. It was a good company. So we didn't see a sharper correction. It corrected 20-30% from the peak, but it remained at the same level for almost 14 to 16 years. And once the stock started to giving earning momentum, then only eventually the stock came out of this consolidation phase. And as you can see, once the earning growth momentum come from $24 odd, this went to a significant higher level of almost $240. This happened for a company like PI Industries. So in India. So, in the global agrochemical market was seeing a very significant M&A, and almost for 3 to 4 years, the order book for PI Industries remained at the same level. It was not growing. But everyone knew that PI Industries is a quality agrochemical company. So maybe the earning growth is not going to come down, but once this consolidation phase in the agrochemical markets gets over, we will see significant earning growth coming for PI Industries. But for this reason, from 2015 to almost 2020, this was a good 4 or 5 years when PI Industries remained more or less flat because of this consolidation which was going at a global agrochemical industry level. So again, quoting Peter Lynch, he said that if I was doing, so just to give you a data, when he was the fund manager with Magellan Fund, in the 13 year of his managing the fund, he sold almost 14,000 stocks during his journey, and his average holding period was just 6 months. But if you look at his performance, as you can see, he delivered almost 29% CAGR return during his management, versus almost 13 to 14% kind of return S&P 500 delivered. So he gave almost 100% more return than the benchmark. But he made sure that this will happen because when the earning growth is coming, he would like to buy the stock, and when he believed that the earning growth is going to taper down, that's the time he will exit it. This resulted into a very high churn, and that's the reason in a 13-year period he bought and sold 14,000 stocks. To quote him, if I was doing my job correctly, the turnover rate would have been even higher. So it doesn't mean that if you are churning higher, then you are doing something wrong. It just means that he was able to understand when the earnings are going to taper down, and that is a time he would like to take a switch from one stock and would like to enter into something where the earning growth is going to be significantly higher. So this we have understood that how earnings surprise comes, and that's how the EPS momentum comes, and the high PE multiple we starts to give to the stock which is showing a strong EPS momentum. Once the EPS momentum starts to come down, suddenly market will start giving low PE multiple, negative surprise will come, then again the PE multiple will start coming down, and that's how the stock will correct. To combine this fundamental aspect with technical analysis, we look into these aspects. From a top-down analysis, what is most important aspect is we should get a confirmation in the longer term, medium term, and in the shorter term that the stock is turning negative or positive. So when we talk about positive, obviously it should get reflected into the long-term, medium-term, and short-term charts. Same is the situation where we have to believe that the short-term, medium-term, and long-term is turning negative. In technicals, there are a lot of patterns which we try to understand. These patterns, a lot of these patterns I could name is head and shoulder or pole and flag formation, triangle formation. Then there is a double bottom, there is a rounding bottom or rounding top. All these kind of patterns we try to look into the long-term charts to understand whether there is an accumulation or distribution which is happening. So there's a simple rule of economics which says that if the demand is higher than the supply, prices will go up. If the supply is higher than the demand, prices will come down. It is applicable to all asset classes, whether it's commodities, currencies, equities, bond. Everything is being driven by one simple economic principle of higher demand, the lower supply, price will go up. Higher supply, lower demand, price will come down. And this is what we try to understand from technical analysis to understand whether the demand is higher or supply is higher. And this we try to get from these patterns. And then there's a very important concept called as comparative strength. Comparative strength is a very important or interesting thing which I would try to explain from the stock or chart so that you'll understand in a better thing. So these are some triggers which we try to understand. Time to sell from a fundamental perspective is first. The growth is not above the average rate. So let's say if the industry is growing at 10%, and your company within the same industry is growing at, let's say, 8%, that itself is a very good signal that the company which we are looking is not able to grow in line with the industry. And if the industry is growing at 10% and you are growing at 8%, means there are other players who have gained market share from you and growing at either 10% or beyond 10%. So this is a clear signal that you are losing market share. And if a company is losing market share, which means eventually the top line is going to come down. And if the top line starts to come down, your fixed costs are same. So the profitability is going to come down. EBITDA margins are going to come down. And that's a very good signal that it is time to exit the stock from a fundamental perspective. Second is competitive advantage is impaired. So there are many such examples. So it could be change in technology, distribution, or regulation, which will lead to your competitive advantage coming down. Let's say there is a metal company which has got a mining license for 50 years, and because of that they were getting all the raw material prices at a very low cost because they had their own mines. So obviously the raw material prices was at a lower price, and the end use price is going up. So the company will make abnormal profits. But after when these mines get expired, so automatically your top line will remain the same, but your raw material prices will go up because now you have to buy from the market, and if the raw materials are going up, you have to buy at a higher price from the market. So you are not going to make the same amount of margin which you used to make earlier, and that's where you have lost your competitive advantage. In this kind of situation, the profitability will come down significantly in a negative environment, and that could lead to significant degrowth in the earning momentum. And that's a time for a lot of these companies where the PE derating will start happening and the price will come down significantly. There's a very important, when there's an adverse change in management. So recently one very good, I would say specialty chemical company, which was quoting at a 40 PE multiple, growing at 22% kind of top line, bottom line, profit growth. Everything was going very well, but suddenly the CEO of the company decided to step down, and that's where market was not comfortable, and in 3 days this stock corrected almost 35%. So this is when there's a significant change at the top level, and market will realize that he was a growth driver, and if these kind of people exit the company, then that's a time lot of profit booking or exit will happen, because we don't give just PE multiple. There is a concept of price to governance also, which we say that if, let's say, two companies say giving the same EPS, let's say 10 rupee EPS 10 for A company and 10 rupee EPS for a B company, but A company has got a very top quality promoter or management. In this situation, market might give him a PE multiple of 40, which means the stock should ideally trade at a 400 rupee. But in B, the market believe that the promoter is a medium category, or a not so good kind of promoter is there. And in this kind of situation, market will say that we are not going to give the same PE multiple. The PE multiple should be given just 25, because the 15 extra PE multiple which you are going to company A is because of high promoter quality or governance. And that's how, with the same EPS, this company might be trading at 400, whereas the other company will quote at 250. So that's a very important role which management or promoter or board of directors play in the kind of multiples which we give to these companies. So triggers for an exit decision: when there is a change in the business environment. So suddenly 2016 post demonetization, GST started gaining a lot of traction, and organized sector started getting a lot of market share from the unorganized players. And that is a time when any company which I would say not organized or not following the rule of the law very properly, a lot of these companies will lose market share to organized players. And this is exactly happened into, again, wire and cable segment, where Polycab, which used to have a market share of 12% in the wires and cables segment, now in just 3-4 years, this market share has grown from 12% to 18%, which means although the industry size has increased, But even when the industry size has increased, Polycab just not managed to maintain its market share of 12%, but also gained market share from smaller companies. So this resulted in a significant re-rating for a company like Polycab and de-rating for companies which lost market share because of the change in the business environment. Then there are balance sheet risks. So obviously, if there is a significant amount of leverage which a company takes, then generally market is very nervous about these kind of leverage. I'll give an example of an agrochemical company, which is a Nifty 50 company. For last, I would say 5-6 years, this name is considered as the biggest agrochemical company, but is getting a PE multiple of just 10 PE multiple. The reason? The balance sheet is extremely leveraged. Whereas the other player like PI Industries, which is not leveraged, which is growing very well, net debt to EBITDA or net debt to profit is at a very, very low level. So in these kind of situation, although PI Industries is also into agrochemical space, but market is giving a PE multiple of 40 times. So in last 2 years, if you would have looked into the price behavior, PI Industries must have given a very good return. Whereas this Nifty 50 company, which is considered as the biggest agrochemical company, is actually seen a price erosion of more than 20 to 30% just because the balance sheet is got extremely leveraged. So then there's a merger and acquisition at peak of cycle. So the best example which comes to my mind is Tata Steel. When it acquired Chorus was bigger than Tata Steel at that point of time, and that's how market said that it has increased the leverage. Merger and acquisition has happened, and that too it has happened when the cycle of metals was at the peak. So So I remember at that point of time, a lot of commodities, let's say manganese, which used to trade at 6,000-7,000 rupee a ton, it moved to almost 40,000 rupee a ton. So that was a time, if you are going to acquire an asset, you are going to get these assets at a very high price. And if the cycle starts to come down, then you have paid a very high price for this acquisition, and the earning is going to see a significant drop, and this will lead to a significant erosion in the profitability, and this will lead to significant de-rating. That's what happens when you do a merger and acquisition at the peak of the cycle. So whenever we hear that this company has acquired the other company, and this has happened in a situation when the cycle is already doing very well, generally these kind of acquisitions market don't like, and it starts to derate those PE multiples. Then there's a valuation risk. So obviously when growth starts to taper down, PE ratios are very high, and market believes that it will take reasonably good period of time for the earning growth to come. That's the time the PE starts to come down. So for example, 2021, because interest rates were at almost at zero level in the US market, everyone believed that the PE multiple, you can give a high PE multiple to company which are giving good reasonable, maybe let's say 10% kind of top line growth. But because there is no debt and these companies are blue chip companies, so it's okay to give them a high PE multiple. It's perfectly fine in a low interest rate environment or a zero interest rate environment. But once the interest rate starts to go up, then the challenge is whatever earning you are going to derive in next 1 year, 2 year, 5 year, 10 year period, it will get discounted by a high discount rate because your interest rates have gone up. And if you are going to discount this by a high discount rate, then ultimately the terminal value of these net or the net present value or terminal value of these earnings or cash flows will come down, which will result into significant price correction. And this is what exactly happened to all growth companies in 2021 to 2023 period. So whether it's whether we call about companies like InfoEdge or Zomato, Paytm, all these companies, they got a very strong welcome from market, because that was a time when interest rates were almost zero. And when interest rates started going up, market believed that now growth is going to come down significantly. So we can't give a high PE multiple to these companies which are not going to deliver earnings. And that's why we saw very significant correction coming into these growth stocks. Governance risk. So as I said, this is the biggest risk. So if there is any kind of doubt about the management quality, then market will not wait and it will significantly derate these companies. So there are few examples which is there for the slides. So now coming to the practical, exit strategies or buy strategies which we have followed. So there was a company called Mrs. Bector Foods. We entered this company around 450 rupee. We believe that this stock at that point of time was making an EBITDA margin of 8%, because that was a time when the raw material prices were extremely high. So the margins came down to 8%. Otherwise, this company used to make a EBITDA margin of 14 to 15. So we believe that this is a good proxy to the QSR theme, because 100% of McDonald's buns are being supplied from Bector Foods. And again, it was a number 2 player in the biscuit segment in North market. So we believe that this 8% EBITDA margin is a temporary situation. Once we start seeing price correction in the raw material prices, again the margins will go back to 14, and that's where the EPS, the profitability will grow. And that was a time the stock was quoting at just 18 PE multiple. Whereas if you look at the other company called Britannia, it used to quote at a 40 PE multiple. So we said that, okay, this is also a FMCG company. This is a biscuit company. This is a good proxy to the QSR theme. Why should ideally trade at a 18 PE multiple? Just because there is a short-term spike in the raw material prices, but this is not going to be permanent. So this PE multiple should start getting re-rated from 18 to, let's say, at least 25. So, as we believed it would be a 25 PE multiple, we started building the position in the stock. We bought the stock at around 460, 470 level. And in the next quarter, the good part is the earning growth which we were expecting, the stock surprised that earning growth. So let's say, for example, if we are expecting a 20% kind of EPS growth, the EPS growth came to 25%. So when markets saw that the growth is significantly higher than what markets were anticipating, market gave a PE multiple of not 25, but it started giving a PE multiple of 28. Again, in the next quarter, earnings surprise. Market said, why should we give a PE multiple of 28? Why not it should be given a PE multiple of 35? And that's how on every quarter, because the results surprised on the positive side, market gave a high PE multiple, and at one point of time, stock reached to a PE multiple of almost, I would say, 35, 40 PE multiple. And this is the time when we thought that, now this stock is quoting around 1200 rupee level, and it has reached to a level of 40 PE multiple. Now, compare a company like Bector Foods versus Britannia, which is a number 1 company. Ideally there should be some gap in the PE multiple. So Mrs. Bector Foods, because it doesn't have a very strong, I would say, all India reach as compared to Britannia, it can't be given the same PE multiple what Britannia is getting. And that's the point. We believe that maybe the stock will enter into a period of consolidation, even if it doesn't correct. But if it enters into a period of consolidation, this could result into underperformance. And that's how we thought that it's a time to book some profits, because it has become very expensive. And that's the reason at around these levels, which you are looking into this chart at around 13, 16, we eventually booked our gains in Bector Foods, and would like for some triggers. Let's say if it enters into a new market, or there is some significant growth opportunity which comes into play, we can always re-enter the stock. But we believe at this point of time the stock has entered into a very high PE multiple, and it can't go to the same PE multiple what we are seeing in Britannia. And that's the reason we thought it's a good time to book again. So you can see that from 470 to 13. 16, it is almost 2.5, 2.6 times return, which the stock has delivered in just 8 to 9 months time frame, just because the EPS growth was significantly higher, and this resulted into PE expansion. Same is the case with a company called HG Infra. So we bought this stock at around 675 levels. This stock moved to almost 920, 930 level, and that's an area where we exited. Now, what is interesting in this case is to understand when we exited the stock. If you look at, this is the weekly chart, which means almost last 3 to 4 months, stock has gone nowhere. This is happening in a situation where your small cap and mid cap index in just last 1 month has gone up by 12%. So what I mentioned earlier is it's not just the price correction what we are focusing. We also need to understand the relative strength or comparative analysis, where we are saying that small cap, mid cap index is going by 10-12%. Then any company which is a part of small and mid cap ideally should do very well in these kind of situation. But if it is at the same level, this means it is also seeing a significant underperformance. Now, why this underperformance came? Because we believe that this company is ultimately related to the infra theme, and the order book for HG Infra was close to 12,000 crore, which was almost 3 times of its current sales. And now, as we approach the Lok Sabha election, generally in that environment, we see the public spending on infra projects starts coming down. So we are not going to see a significant, order book expansion. So which will result in the profitability might remain at a flattish level. So you are not going to see the EPS growth, and this will result into stock remaining sideways. But whether this is a good company or bad company, so the answer is it is one of the best company in the infra space which we have been observing. And once we see there is an uptick in the order book, that's the time we would like to reinitiate our long position. But this is how it has helped us in reducing the underperformance, because as you can observe, for last 3 months, stock has remained sideways in an environment where small mid cap has done extremely well. And that's where even if the stock is not seeing a correction, it's very important to book gains and find something which is more interesting in terms of earning growth momentum. So this is an example of specialty chemical companies. So you remember this period when in 2015-16, the entire specialty chemical got re-rated because of China plus one. We used to have almost just 3% market share in the entire specialty chemical, whereas China used to control almost 36% of the specialty chemical market. So there was a lot of these global MNC buyers. They made it clear that they want to find an alternate source of raw material, and that's how India gained a lot of market share in the specialty chemical segment. So suddenly the P started getting re-rated from 10 to almost 40-50 P multiple. But as I explained, in 2021, when interest rates started going up, it all resulted into significant slowdown in the global market, and this resulted into top line degrowth for a lot of these specialty chemical companies. So that was one reason, and because raw material volatility started going up because of the supply chain challenges which happened due to Russia-Ukraine war, it resulted into significant derating. Now, how technical helps is there was a company called as Lakshmi Organic. We were very gung-ho about this company. I first bought this stock around 160 rupee. This 160 rupee stock went to almost 600, 620 in just 6 to 9 months time frame. So there was a significant earning growth which started happening, and this company also was entering into fluorine-based chemistry. So again, market said that okay, they are entering into newer product ranges where the margins are going to be significantly higher, and that's how market gave them a very high PE multiple. But post 2021, since the scenario changed, suddenly there was a derating in the PE multiple, EPS, and that is what we try to understand from technical. What we saw on the technical side is there was significant breakdown which started happening, and exactly on this first breach of important support levels of 450, we exited Lakshmi Organics in our portfolio. Now, what has happened? It is not that the stock is corrected from 450 rupee to 270 rupee, but the important point is in this last, I would say 1.5-2 year period, the stock has remained sideways in an environment where a company, just to give you an example of one of our portfolio company called Titagar Wagon, which we bought around 330 rupee holding even now, which is quoting around 1100 rupee. How can you, if you don't have a liquidity, you'll not be able to buy these new themes. So it's very important that if we believe that the stock is entering into a serious consolidation phase or profit booking phase, it's important to exit the stock and enter into something where we expect the earning growth to be significantly higher. And that's where technical helped us in identifying that this trend is changing. It is breaching important support zone. The selling is with a very high volume, which means smart money is exiting, and every time there is a rise in the price, as you can see, there's a resistance at previous support. Every time there is a rise, it is getting, there's a lot of supply at higher levels, which is resulting into stock coming down again and again. So there was 3 attempts when the stock tried to go up, but eventually, it failed to cross the previous support zone, and which ultimately the support turned into resistance. This is the language we try to use in technicals. So if support, if the support becomes resistance, which means the stock has entered into a very serious, downward trend. And till now, it is last 2 years, Laxmi Organics has been in a consistent downward trend. But this is not exactly the case with SRF. So SRF is one such quality company, because market believe it is into fluorine-based chemistry and where the margins are significantly higher. But it is facing challenges. Obviously, the same challenges which is applicable to Laxmi Organics are applicable to SRF, because if global slowdown continues, then SRF is not going to see significant top line growth, and which will not result into profitability. But because market believes in the potential of or quality of the company, what market did with SRF is just it didn't correct it. But the challenge is, in the last 1.5 years, SRF is also into a consolidation phase. So there are two situations. If you are in a sector which is going to get derated, the quality company will correct lesser, but will go into a consolidation phase for a longer period of time, whereas a average company will see a sharper correction and can see a correction of almost 50, 60, 70%. So in this case, Laxmi Organic was 600, it came down to 270, which is more than 60% correction. Whereas in case of SRF, it topped around 2700, quoting at 2350. So hardly there is a 15, 18% kind of correction. But the point is, last 1.5 years, nobody is making any significant money in SRF, just because the sector is into a downward trend. And that's where it's very important to, so ideally if someone exits, let's say when we believe that, okay, the growth is not going to come down, and if it would have sold the stock 9 months, 10 months back, so that liquidity has come to you and you are able to buy something which is doing much better, and you can always re-enter SRF once the earning growth momentum starts. So which means SRF is a good buy and hold company. We also agree. But the point is, it can result into a significant underperformance if we are holding and the stock is not able to generate return because the earning growth is not coming. For cyclical sectors, there is a very different style of entry and exit. So generally, we say that in a general phenomena, if the stock is at a low PE multiple and earning growth is high, then that's the time we have to buy the stock or the sector. But in case of metals, it is contra. We say that we should buy metal only when the stocks are quoting at a high PE multiple. Now, what do we mean by it? Let's say a metal company is trading at 100 rupee and the EPS is 5 rupee. So, which means the stock is trading at a 20 PE multiple. Now, what does it mean? It could mean that the earnings are so depressed. The earnings are so depressed that the PE multiples are high. Because the cycle has been in downward trend for many years, the earnings which used to be 20 rupee EPS for Tata Steel or any other company, let's say for example, it has come down from 20 rupee to 5 rupee. So this is the bottom of the cycle, and that's why the PE multiple is looking very high. That's the time typically cyclical companies, a lot of people enter when they enter into a high PE multiple because earnings are very depressed. So this is what we did in Tata Steel in 2020 when the stock was quoting around 270 rupee. That was a time we entered into metals, because that time the PE were very high, which means earnings were depressed, and now the cycle is turning because we looked into the charts of iron ore, magnesium, steel, and we realized that these commodities are showing very strong uptrend, and if this uptrend continues, ultimately the earning growth for a lot of metal companies will improve, which means this 5 rupee EPS which is coming for, let's say, a particular company, this EPS will go to 5 to 15 or 20. And if it becomes 20, obviously the PE multiple will come down from 20 to just 5. So generally we should avoid buying metal companies when they are quoting at a low PE multiple, which also indicates that your earnings have improved to such a level that earning has become very high. And that's the reason why the PE is looking very low. So in a metal company, the style is to buy when they are quoting at a high PE multiple. So as I explained in 2020, as HRC prices started to move, Tata still witnessed a similar move, and this was because this is the post split number. I was talking before split, it used to be 220, 230 rupee. It moved to almost 1400 rupee. But this is after all adjustments. So typically 2020, the stock was quoting at around 25 rupee. It moved to almost 140, 150 rupee. After it went almost 3x. Generally the stock entered into a consolidation phase because commodities entered into a consolidation phase. If commodities would have continued to see an upward swing, we could have seen Tata Steel or JSW or Jindal would have continued their upward trajectory. But if you would have observed in the last 6 months, metal prices have more or less remained flat. Copper, aluminum, zinc, steel, all these commodities have seen 20 to 25% correction from their peak. And this is the reason why metal companies are not participating, because obviously metals are also dependent on the global economy, and if global growth comes to question mark, metals demand will slow down. And obviously there's one very interesting thing which we follow with metal is look metals with the dollar index. So if dollar index is going up, which means dollar is gaining a lot of traction, then in that situation commodities will see correction. So there is a inverse relationship between dollar index and commodity index. If dollar index comes down, there is a good possibility your commodities will go up. So these are some of the important trends which we try to look when we try to buy any kind of a metal company or commodity companies. So 2000, yeah.
We have a question here. The Tata Steel chart, what's the periodicity of that? Is it weekly or monthly?
So this is a monthly chart. As I said, we have to look from a longer term perspective. And this is a very interesting question you asked, Shraddha. I want to indicate one more thing. If you look at this chart, so this is 2008 when the stock peaked out in the last cycle. And it took almost 14 years for the stock to reach back to the same level. So in the commodity companies, if you don't enter at a right time, or if you don't exit at a right time, it might take 12 to 14 years for your money to come back to the same level, or you to coming back to the break-even point. I'm not talking about the interest loss which you have lost, but just from a price perspective, Tata Steel was at 80 rupee. This is after about all the adjustment of the bonus and splits. So 80 rupee, and it took almost 14 years for Tata Steel to come back to the same 80 level. So this is the challenge in the metal companies, and that's why a lot of money managers they typically avoid metal companies because of this one specific reason, because it's very difficult to understand commodity cycle because it's so global dependent that you can't predict the prices of iron ore or steel, and you can't predict its earning growth. And if you can't predict earning growth, you'll always give those companies low PE multiple, and that's the reason a lot of people avoid metal. But again, technical helps us in understanding the trend in the commodities, and that's why it's far easier if someone is using these indicators to understand the demand supply situation. And if you're able to understand that the demand is going to be higher in commodities, then automatically this will get reflected into the prices of metal shares. Yeah, and one more important thing which has happened in 2001 to 23 is shift from growth to value. So we have spoken about how high interest rate resulted into low PE multiple for growth companies because earnings are going to discount at a high discount rate, and this will result into the terminal value. So suddenly, if there is a shift in a sector, or if there is a shift in the overall thesis, then this will result into a significant derating into the themes which were running up, and it will result into significant re-rating for sectors which were considered as sectors which are going to remain sideways. So if you would have observed, a lot of people would have said in 2018, 19, 20 period that we generally avoid PSU banks, PSU companies, defense companies, railway companies. But if you look at the performance in the last 2 years, if someone would have missed the trend in railways, where Titagar Wagon has moved from 300 to 1100, Jupiter Wagon has moved from 120 rupee to almost 300 rupee, or a company like Railtel, which has moved from 100 rupee to 300. There is a significant money which got created in these themes. Or let's say, just to consider, because I have been recommending a theme called PSU banks for last 2.5 years. When PSU bank ETF was quoting at 20 rupee, we started recommending because we believe that this ETF is available, or most of these PSU banks are available at 0.3, 0.4 time price to book. NPS cycle is behind because post IBC and post insolvency code, now there is going to be less NPA. So if the NPAs are going to come down, then obviously these companies will see lot of growth in terms of their earnings. So market should ideally give them higher price to book, not equivalent to what you are giving to a private bank. So let's say if the private banks, HDFC Bank or ICICI Bank, is quoting at 3 times price to book, then generally a 1 to 1.2 time can be given to PSU Bank, and that was a thesis which we applied when we saw a shift from growth to value. And that's how in the 2-year journey, the PSU Bank ETF, which was quoting at 20 rupee, it moved to almost 60 in the last 2.5 year period. But if you would consider the same amount of time frame, then in this 2-year time frame, the least performers are basically private banks, because they have not delivered any return. And if you look at year to date, HDFC, ICICI Bank, they have given almost either negative return or flat return. But in the same period, we have seen significant price movement into the PSU banks, because there was a shift from growth to value, and that is what we need to understand. So I've used this example from charts. So Info Edge, which is considered as a growth stock because it has got a business like Naukri.com, and they have got invested companies like Zomato, Policy Bazaar. So everyone can, and I was also a very firm believer in Info Edge's growth potential. So that's how I started recommending Info Edge from 1200 rupee. Stock moved to 74.65, and at 7400 also we were positive, because we believed that India is a growing economy, and if interest rates are going to remain low, then companies like Info Edge will be the biggest beneficiary. But where the thesis failed, when interest rates started going up in the US market, and suddenly growth stocks started seeing derating in the PE multiple. This got reflected into the price behavior of Info Edge, and this is a simple tool which we can use, is a lower top, lower bottom formation. So as you can see in this, when the stock was going up, every time the top was higher than the previous top, and the bottom was higher than the previous bottom, which is what we call as higher top, higher bottom, which means the trend is positive. Every time the stock goes up, it goes higher than the previous top. Every time it corrects, but the correction is lesser than the previous correction, and that's why the bottom is higher than the previous bottom. But when the thesis changed, suddenly the stock started making a lower top, lower bottom. When it consecutively made lower top, lower bottom on the weekly chart for 2 to 3 times, that is a time we said that the growth stock is coming under significant pressure. We might have a positive bias on the company, but it is a time to look for an exit. And that's how a stock which I was riding from 1200 rupee, I saw 7400. At 7400, if someone would have asked me, I would have given a positive commentary. But eventually, because of this change in the fundamental macro event, and the same getting reflected into the technical chart where it started making lower top, lower bottom, we exited Info Edge from our long position. And from 5500, today the stock is 4500 after 2 years, which means it corrected from, first of all, 5500 to almost 3000. And in the 2-year period, still the stock is 20-25% down from the 5500 level where we exited, and almost 40% down from its all-time high. So which means when the markets have started moving from 12,000 to 20,000 in the same journey, a growth stock which is considered as a blue chip company has actually corrected from 74.65 and still quoting 30 to 40% from its all-time high. But in the same time frame, there was another theme called as CPSE. CPSE is nothing but a basket of all public sector enterprises. So it might include ONGC, NTPC, Hindustan Aeronautics. We looked into the chart of Info Edge in the CPSE in the same period, and what you are observing is this CPSE ETF, which has not delivered any return in a 8-year time frame. So last time it saw a level of 2500, it was in somewhere around in 2016-17, and it finally crossed the same level in 2022-23. So there was a good consolidation of 8-year, which means any investor who would have put money in this ETF in 2016-17 would have not made any return. But suddenly, because there was a shift from growth to value, this CPSE ETF started making a higher top, higher bottom formation, and it gave a breakdown, whereas InfoEdge gave a breakdown, whereas CPSE ETF given a breakout. And that was a very good confirmation that there is a clear shift which is happening from growth to value. And that's how I started recommending CPSE ETF, which used to be around 22 at that point of time. This ETF, which was 22 rupee at 2 year back, is now quoting around 55, 56, and still hitting fresh all-time high. So there are still no signs of any weakness which is being witnessed in the ETF, in the CPSE ETF. The reason being, government is focusing a lot on power sector, and a lot of these power companies, whether it is NTPC, Power Grid, Power Finance Corporation, REC, all these companies are going to be the biggest beneficiary of government's power sector reforms which they are doing. So we are going to do almost 500 gigawatt in the renewable energy in next few years, and government is saying that in the next 5 years itself government itself is going to put 30 gigawatt of thermal capacity. So the thermal capacity addition used to be 1 gigawatt, 1.5 gigawatt yearly. Now that number is going to grow to 5 to 6 gigawatt on a yearly basis, which means it is going to be very positive for companies like NTPC, Power Finance Corporation, and private power players like Tata Power and all. So this is getting reflected into the price behavior, and that's how the CPSE ETF is consistently hitting fresh all-time high, no signs of weakness, whereas InfoEdge, despite seeing so much correction, is not seeing any signs of strength because of this shift which has happened from growth to value. Yeah. So Shraddha, I think we are getting out of time, so I know we can do Q&A because this is a lengthy presentation. So
Yes, definitely, Ashish. So, team, if you have any questions, you may put them in the chat box, but let's address till then the ones that are already there. So one of the questions that we already have here is, Ashish, how are you plotting delivery quantity versus total quantity? What indicator would you use and on which software?
So every software actually has this feature. So obviously we use Falcon, where let's say if the trading volume is 1 lakh shares, and if we impose what's the delivery quantity, it will get reflected into the bar chart of the volume, where let's say 70% is the delivery volume, then automatically it will get reflected that 100 is the volume and 70 is the delivery volume. And if there is a consistent rise in the delivery volume, then it's a good indication that a lot of accumulation is taking place. Or if the stock is seeing a correction and the delivery volume is increasing, that is also indication that a lot of people are selling in delivery this stock, which is also a sign of great distribution.
Understood. The other question we have here is, what are the key technical indicators you use that helps you decide your exit besides the patterns?
So, we try to combine both from a fundamental and technical perspective. So obviously fundamental factors we have discussed in detail. From a technical perspective, we try to understand if there is a multiple breakdown on the monthly, weekly charts. If there is a significant pattern like head and shoulder, or there's a double top formation, or there is a rounding top formation, then that's also a very good confirmation. Apart from that, we also try to understand relative strength. So if we see that any particular company which we are observing is showing a very weak relative performance. So let's say let's take an example of IT sector. So if IT sector is going up 5%, and a company which we are holding in the IT company, whether it's mid cap or large cap, and it is going just 2%, that's also a confirmation that somehow the stock which we are holding is not seeing the same amount of strength which a which the sector is indicating, like Nifty IT. So which means there is some amount of relative weakness, and that's the time we try to evaluate it from a fundamental perspective also, why this kind of underperformance is going on in our company. And if we find some good reason from fundamental perspective that maybe because the entire IT sector is doing good, but our company is not doing good because maybe he has lost some good clients, or the technology which it is working is not gaining traction. So this could result into the earning degrowth, which is getting reflected into the price behavior. So that's a very good reason for us to sell those kind of stocks also. Then one more thing is gap downs. So gaps are very important theory in technicals. If there is a gap down and a consistent gap down in our stock, and if the normal market is going as usual, which it used to trade, then that's a very good confirmation that it's a time to take an exit decision. And this I'll try to give an example from one of the charts which we have with us. Just a second. Yeah. So this is one example where you are seeing few gap downs which is happening in the stock, and these gap downs are associated with very high volume, and generally this is a good confirmation that some serious distribution is taking place. So that's the time we try to exit the stock. So gap downs are something which are very important in terms of identifying exits. So this is the case of a company where it saw a gap down, and this gap down was associated with very high volume and a big bar on downside, and that was a confirmation that the stock is not going to see recovery, at least in the medium to long term. So it's better to take an exit decisions.
Okay. Another interesting question we've received is, how should one behave in a situation where the stock fundamentals are pretty strong, but market sentiments are continuously pulling down the overall market and the panic situation prevails regarding a particular stock or overall? So how should one behave?
So there are two situations, I would say, Shraddha. One, where if the markets are correcting and our stock is correcting, you can't do anything. You have to just do meditation, go for a walk, or start going to restaurant and avoid seeing. And what I do is I hedge the portfolio in those kind of situations. When we see that generally markets are going down, then the best of the stock will see correction. So the best thing as a money manager, what I can do is to protect the downside through hedging. But the problem comes when markets are stable or markets are going up, and you think the stocks which we are holding is fundamentally sound names, but they are underperforming. And this is what I explained in pharma sector or auto sector, where in auto as a basket. So just to give you an example, this is a good example which will be of help. So this is auto as a basket. Post IL&FS crisis, there was a very, very low growth in the entire sector. So the index itself corrected from 11,500, as you can see, from 11,500 the index corrected to almost 4,000, which means although the broader markets did very well. So initially post IL&FS, even Nifty corrected for good 5-8%, but after that we saw a significant rise in the broader market, but auto sector didn't recovered, and that's what we call as a relative strength concept. So if auto index is correcting, whereas our broader markets are not correcting, that is also a sign that there is some amount of distribution which is taking place in the sector or companies which we are holding. And as we say, market may remain irrational longer than one may remain solvent, and that's the reason why we have to continuously monitor the situation and try to understand if our stocks are underperforming, have started underperforming, then there could be some possible reason. And if we see some serious price changes, then we have to exit. So this was the example of Maruti. I was holding Maruti from 5,000 and it went to almost 9,900 in 2017-18 period. And when it made a double top and when it started seeing a breach below its important support zone, exactly around 8,800, we exited our position in Maruti. So, we'll at 8,800, I was also not sure whether the stock will correct to 8,000 or 7,000. To our surprise, the stock corrected till 4,000. So who would have believed that a largest cap, auto company, which is a market leader, which used to have a market share of almost 52% in the passenger vehicle, it will correct from 9,900 to 4,000. So when we exited the stock at 8,800, we were not aware that whether it will correct to 8,000 or 7,500. But one thing we were very sure is there is some distribution which is taking place. This is getting reflected into the behavior of auto index, and it is not going as per the broader market. So which means broader market started recovering, but Maruti is not recovering, which is also a sign of weakness. So this is a time to take an exit decision, and that's how when we exited the stock from 8,800, it corrected 50% from our exit level. And finally, the same stock we entered at 7,500 after it consolidated for good 4 years. So even if I would have bought at the lower levels, I would have to waited for a very long period for it to give me returns. So I waited for good 4 years, and when it gave eventually signs of breakout, then we eventually entered the stock into the auto space, and this is exactly in 2021-22 period when COVID crisis, post-COVID crisis, there was a demand for the SUV segment, and there was a shortage for semiconductor, which resulted in almost 6 to 7 months waiting period for cars, and suddenly demand started coming down, and all this resulted into a re-rating into the auto as a basket. Hello. Yes, Shraddha.
Yeah, so another question we have here is what are the risk management measures that you adopt on an individual stock as well as on portfolio level?
So for that, we do a lot of things. So from a quality perspective, we make sure that we don't go beyond 40% in small and mid cap. So generally that's a range which we follow. So typically 60-65% of portfolio at all point of time is into top 200 names. So that quality check is already in place. That is point number one. Second, as I mentioned, relative strength is something which we always look. So if the relative strength is missing, which means there is something which we are not trying to understand or markets are trying to anticipate in advance, that also gives us a very good indication, and we try to take an exit. Then there is a concentration risk, so we don't take concentration risk. For example, when we were of the belief also that because railway is going to see a capex of almost 2,40,000 crore, it is going to see a significant re-rating into the railways sector. But because railway sector, all these companies are actually dependent on government for their order book and all those stuff. So there could always be a volatility because of some change in policies and all this. So we make sure that even if we have to take a bet in the railway theme, we are not going to take a concentrated risk. And that's the reason, even if I have to take a bet of 5% or 6% in the railway as a theme, I will take minimum exposure of 3 to 4 names rather than betting on one name. So because of this one name, maybe the results, if the stock gets significantly re-rated, the portfolios will see a significant jump on upside. But if we go wrong in our assumption, then this one call can result into significant drop in the portfolio performance. And that's the reason why we always say that we have to diversify. Even if we have to take a risk in the concentrated sector, then also it needs to be diversified in 3 to 4 companies. So that is also one way of managing risk on downside.
Okay. Another interesting question that we've received is, do you apply stop loss for entry and exit? And if yes, what are the determinants?
So not really. We monitor the situation on a regular basis. We don't have a fixed stop losses because we look into a lot of other aspects, as I mentioned, and fundamental is also a key criteria. So if the fundamentals are in place and if there's a small dip into the stock, then if we apply every time stop losses, the stop losses will get hit and the stock will see recovery. So that's not the logic. What we need to understand is if there is a serious underperformance which is coming against the broader market, against the sectoral market, or there is some serious bad news which has come into the stock and it is resulting into some serious drop into the prices. That is point number one when we try to take an exit. Or if we believe, like in case of example like SRF, so we like SRF from a long-term perspective. We believe if we have to enter into specialty chemical, the first name we are going to enter is going to be SRF. But whether it is a right time to enter into specialty chemical, there's a question mark. We believe that still there is 1 or 2 quarter where the growth will take place. Time will take for growth to come back to the specialty chemical companies, and only when we will see the growth coming back to the specialty chemical companies, that is a time we will take an entry into SRF. So time consolidation is also a good indication that we need to exit the stock. Otherwise, this will result into serious underperformance. So what we see is not just price correction, but even if we believe there is going to be serious amount of consolidation, whereas the broader markets are going to see an uptrend, then we are going to take an exit decision. Let's say if the broader market itself is going to enter into a consolidation phase, then I don't have any problem to remain into a sideways stock. So that's why I said it's very dynamic in nature.
Out of the time, I think we have an interesting question with which we can wrap up the call. What's your broader market outlook in India for next 3 to 5 years?
So, we did one event around Diwali, and that was a time this entire Hamas issue was there, and there was a lot of talk about, the crude going 70-75% from where it is. The IMF predicted that if it escalates, then this could result into a significant rise in the crude prices. And then we showed the chart of crude, and we said that this is not getting reflected into the prices. So ultimately, what we believe is India is in a very strong growth phase. We have already hit, some data suggests that we have already hit a $4 trillion economy, if not lesser. So these are some of the numbers, and the way capex is happening, manufacturing is happening, PLI schemes are being introduced. We believe we have entered into a significant growth phase. Till now, what we were always given a high PE multiple, but we were not seeing the same amount of EPS growth for our Nifty 50 companies or overall market companies. But in the last 1 year, we have seen a significant earning growth which has started happening. So my sense is this capex will lead to significant amount of EPS growth in next 3 to 5 year journey. Obviously, election will play a very important role, and that's the reason we said we always have a friend called hedge, which will give us some amount of protection in case things go out of control. But what we believe is if the current government continue, then there is a very strong possibility these reforms will continue. This will result in a significant capex, manufacturing, and this will lead to a lot of growth. So overall, India is going to see good growth in next 3 to 5 year time frame. So not only the consumption theme, but also all capex manufacturing theme is going to see traction. So if you would have observed from 2008 to 2020, India was more of a consumption-led economy. So for good 10-12 years, whatever rise we saw in our market, it was more dependent on the consumption. But last 2-3 years, the entire growth is coming from manufacturing and capex theme. And generally, when this capex manufacturing starts to happen, it typically lasts for good 5 to 7 year period, and it is just second or third year of capex and manufacturing. So we are yet to see the full benefit of this manufacturing growth, which we are going to witness.
Thank you so much, Ashish. Thank you so much for your views. I know we overshot time, but I'm sure we couldn't have done this any better. Secondly, I would like to thank each and everyone on this call for being so patient and for your active participation. Have a great evening ahead.
Thank you everyone for joining this call. Thanks, Shraddha.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.